Thank you, Patrick.
Yeah, it's great to have you with us, Michael. And like Patrick said, we're all sort of technical chart analysts, and I've always thought it's a great idea to sort of bring everybody's views and ideas together and just see how different analysts are seeing the same charts and analyzing the same sort of price actions. So it's we've got the first chart here. I think Patrick's teeing up for us. Looks like the Bitcoin chart. Was that the one you wanted to look at first, Michael?
Yeah, we've got 3 Bitcoin charts. We show weekly price, and this is going back before the futures began. That was in December of 2017. It was near the top of that price chart you see there. There's the last 4-week surge went from like $8,000 to 20,000, and that was in anticipation of in the start of the futures trading of Bitcoin. Look at the price chart; it's weekly. Yeah, and we got overlaid a 40-week average. What's a 40-week average? Well, it's about the same as 200-day, except it adjusts weekly. It's about the same as a 3/4 moving average. So it's a fairly long-term average. And frankly, we don't care whether the price action gets above or below that loopy line that's plotted on the price chart. That's the way most people use moving averages. They want to know if it crosses over. Well, by the time you cross below that 40-week average, you'd already seen most of the collapse. So it was a worthless indicator in that regard. But the chart below is a momentum chart, and what we've done there is we plot each weekly bar, mathematically, how much above or below is that week in its relationship to that changing 40-week moving average. It's a certain percent above or it's a certain percent below. We plot a bar. So it's the same size bar as the price chart, but it's just in relation to the mean, in this case, the 40-week average. And we get an oscillator. And usually momentum charts, and again, Momentum Structural Analysis, which is my company, we've been putting out research since 1992 using these same methodologies, very few tweaks over the years. We don't pay attention too much to what anybody else is saying technically or whatever. We keep our blinders on, so we're not biased by sentiment or anything of the sort. But look at the Bitcoin chart here. On the way up in price, you had this nice little staircase pattern about in the middle of the chart there. You see the night up and down or up and down. It was orderly, reasonable uptrend. And then suddenly it went vertical. That's what's called a blow-off. Well, when you look at the momentum chart, you'll see that sequence of little humpy highs that made higher highs kept pressing up at about the 200% level, meaning the price was 200% above the 40-week average at each of those peaks. Even though the highs were higher on price, the momentum was banging into the same level. And finally, it said enough, and it blew through that. In the last 2 to 3 weeks of that price acceleration that you see on the price chart, momentum told you before that happened that it was about to blow a cork because it was a very clear ceiling. It's like the elevator going through the top of the building, boom, okay? The problem was when you get a blow off like this, where it's, bubble time, and you know it. You just don't know how far it's going to go, and you also don't know when it's going to break down, because when you look at the price chart, if you try to draw an uptrend line on that price chart through pivotal lows, let's say starting in early 17, you can't draw a reasonable uptrend. You get 2 points, and then the next low doesn't even hit the line, and it's sort of an upward curve. So it's really, you can't plot a trend line. But on the momentum chart, you could plot a 4-point uptrend line, and you also had the ceiling that you broke out above. So we've learned over time, and the very last chart we'll look at today will be similar to this, except even more exaggerated. I won't tell you what it is right now. But when Bitcoin, 1 or 2 weeks off the high of the price action, it sat back on top of that ceiling, the red line. And what was resistance became support for a couple of weeks. It's when you came back and closed back below that prior breakout level on momentum. We call it an abort. Remember, like the old Cape Canaveral rockets that went up, and they'd go up about, a mile in the sky, and then they come collapsing back down, okay, back in the 1950s, okay? That's what happens when you get an abort like this, is it's telling you that the blow off is over. The verticality is probably going to be met by the opposite. And the first step in breaking was to get back below the red line. Well, I've circled on the price chart where that occurred. It was off the high a bit. Unfortunately, Wall Street Journal quoted us back then before the high was reached. We described this as a bubble, and it would collapse. But we did say something positive then. We said that when it's over, and when the market has met its reckoning, that it would be a mature market at that point and be worth looking at again. Our projection in our reports was we'd go to 5,000 from the 20,000 high. Well, you could see where it went to. It went to 6,000. It went to just above 6,000. It went to 6,000 and built a floor. Tried to not go to 5,000. They kept buying it at the same spot. Well, finally, it not only went to 5,000, it went down to 3,600. We were fully satisfied at that point that, okay, that's the wipeout. Now the question is, what's next? Now, if you flip to the next chart, we'll see what's next. Okay, now this doesn't show current action. This only goes up to February of this year. But it goes back to February of 2018, and you could see when you made the $3,600 price low there in late 2018, you came roaring up out of there, and you had a nice uptrend, nice surge, came back down to 5,000 again in 2020, and that's when the big move began. So from July of last year, now look at the momentum chart first. There's a tube that momentum was in. In fact, it's a parallel channel. You can circle high weekly closes in the momentum chart, and you can circle a couple low weekly closes, perfectly parallel. And that green arrow notes when momentum said, okay, I'm breaking out of this downturn. Well, there's a black arrow on the price chart showing where that breakout occurred for momentum. And it occurred before price ever got up through its red line structure, which was later in the summer of 2020. But then Bitcoin broke out in price following the momentum breakout and had its move. And here we only show it going up to 40,000. Now, here's the important thing. In this line, the red line on the momentum chart goes back to the peak weekly close that occurred in 2019. Back then, price was like 12,000 bucks. There was a peak momentum weekly close there, and it was a reference point for us. So in the summer and the fall of late last year, no, in the winter, it was November, you came up and butted against that high weekly close and backed off. And then you gapped through it and it started to explode. Now, there was a pullback after that initial explosion through the red line, and that was January of this year. You had a pullback that closed the week out precisely on the red line, meaning it sat back on top of what had been the prior peak weekly oscillator close of 2019. Now, price didn't sit back on that high. It would have to go down to 12,000 bucks. It pulled back to 30,000. But momentum sat right back on top of that peak weekly close and turned up again. Now flip and you'll see the current chart. The third chart we need to see.
I didn't, I moved it now?
There's a third chart, yeah. No, I'm sorry, I'm sorry, you did flip.
Yeah, okay, there you go.
Okay. Yeah, now look at the black arrow again on the momentum chart, the upward arrow that occurred in January. Okay, that's when it sat back on the old high. We thought it would hold there, and it did. And when it turned up, it told us, okay, you now have your line in the sand. Watch that red line going forward, because that's a pivotal structure. It was a major peak. It was a major pullback low. You don't want to go back below that red line on momentum. Okay, now you'll look at the surge that occurred after that second black arrow. Momentum went back up near the high. Price went to new highs, went up to 65,000. And 1 week off of the price high, when you opened that week, 1 week off the high, you dropped down below 60,000. And our weekly report at that time said 59,000 was the number you don't want to see. Well, they opened there, they dropped to 50,000, came back up to 59,000 2 weeks later, and that red arrow on the top chart. But momentum at that point, 1 week off the high, blew back below that major pivotal structure. So at that point, and again, fortunately, Wall Street Journal picked up on it, and we said, that's it, it's broken. Bitcoin's broken. Our projection was that the decline would probably find support, probably temporary, but its first support in the upper part of the 30,000s. And if you look at the price action there on the top chart, sure enough, for 4 or 5 weeks, the weekly closes were all in the 36,000 to 39,000 zone. So it tried to hold first support. Didn't hold it ultimately. So momentum right now on this chart is still eroding. This is 1 week old, and there's not much change. Bitcoin's down a bit this week. So we don't see the potential here for Bitcoin to turn up in a way that will sustain. We could see a big rally coming because we use lesser time scales. This is a pretty long-term momentum chart, but when we go down to things like, a 3-week average oscillator or a 10-week, much shorter term time frame, they do have some structure that it won't take a lot to generate a good rally out of Bitcoin. The problem is that this big long-term chart says, any first rally is not going to sustain. It might be impressive, but you're going to have to work for a while. Much like this chart worked before it generated those 2 prior big up waves in Bitcoin. It did a lot of work, basing action. We suspect Bitcoin is in for a period here where you might be near the low, you might make a marginal new low. We don't think it's going to collapse back down to 10,000 or anything like that. We probably not even back to 20,000, which was its 2017 high. But it's going to have to work, and we think there could be a nice rally coming up soon. But that rally is not going to be one that just keeps going. It's going to have to, Bitcoin is going to have to bide its time and do some up and down exercises and build a base. So anyway, that's our assessment of Bitcoin. Now, there is a market out there on the next chart that is my suspicion that silver is about to become the next Bitcoin in terms of upside aggressiveness. This is silver chart, price chart going back to 2009, and you can see the 2011 high up there near 50, which is where it peaked back in 1980. Same price level, the bunker hunt days, okay? Well, silver then collapsed into a bear trend, and it continued down just like gold into early 2016. And our long-term gold work in February of 2016, a little bit off that silver price low, gold was $1,160. We turned major bullish on gold because of annual momentum. But in the case of silver, silver continued to underperform gold for the last, the 4 or 5 years there in that basing action. Gold was going up, silver was going sideways. So it was underperforming gold. But now look at what happened last summer. Look at the red line on the momentum chart. There's 2 peaks there that were exactly identical in terms of how much over the zero line with those peaks, meaning how much was the price of silver above its in this case, a 36-month average. It's like a 3-year moving average. Pretty long term, more long term than that 40-week we looked at on Bitcoin. During that time, silver made 2 prominent highs. One was at 21 bucks plus, and the other was at 1954. That was in 2019. So the 2 highs there don't match up. But on the momentum chart, they're exactly the same percentage above the 36-month average. So it's a perfect dual peak. So we knew that if you could ever get back up and touch 20% over the 36-month average and take out those twin peaks there, that you would get a sharp move in silver. Well, that was July of last year. And the price at which it did, it was at $19.44 in early July last year. In 3 weeks, it was at $29 and change. So it went up 50% in 3 weeks after blowing out that triple top breakout on annual momentum. Now, since then, we've had behavior by silver that is what? Well, look at it. Look at the price chart. It doesn't look like gold. Gold zigzagged down, silver zigzagged sideways. So even on the price chart, it looks pretty tough. It didn't do what gold did. It looks more like an ascending triangle, of anything, if you believe in price chart orthodoxy. And the momentum chart, similar thing. You haven't even dropped back to use support on momentum. Drop back to the red line to use it as support. It's held stoutly. So I think that silver chart. Now flip to the next page. You'll see.
Michael, it's
Yeah.
is there an echo? Oh, it's me.
I'm sorry. What?
Sorry, I think I'm hearing myself double. But it's so you could do technical analysis on the momentum indicator, and then you could identify your lines in the sand. So this kind of, Kevin could probably say this looks like a bull flag or a pull flag pull, and you could even have a measured move of how stretched away you could get from your 3-year moving average, right? Eventually.
Well, actually, when that breakout occurred, we projected that the thrust would get you to about 30, and it did. It got to 29.90 or something like that. And then you went into this massive congestion zone, which is now, a year old. Okay, now we're looking at silver a little closer up here. You can see that same surge And you can see like 3 weekly bars there. They went from just above, they went from 20 to almost 30 in the first surge, or 3 weekly bars there. So a 50% move, this is called chaos theory. It's not incremental moves. This is the kind of stuff I think silver could produce even bigger coming out of this congestion zone when it's ready. You have to watch gold for that. You have to watch silver for that. They both will move together. But silver is now an outperformer to gold. When we measure silver on a spread basis, measuring silver price versus gold, when we broke out summer last year, its spread versus gold also broke out, meaning that multiple years of underperformance by silver ended technically. And if you'll notice, you can tell by looking at the price chart of silver since last July, it's effectively like sideways. Gold's been down. So even during that period, silver's continued to gain relative to gold. While gold pulled back, silver went sideways. Okay, now what we're looking for here on the bottom chart, we're back to that 40-week average again that we used on Bitcoin, which is less long-term than that 36-month average on the prior page of silver. What we're looking for is a reason to assume that this congestion is ending. You can look at the price chart and you can say, well, if you go up above 30, clearly it looks like it's breaking out above the ascending triangle. So no doubt people are, price chart technicians, that's what they're looking at. When you look at the momentum chart, you've got this downturn that was sharp initially, like 6 weeks off the top. You had a sharp price break that took you to 22 bucks, and momentum came down real hard. But then momentum went into a more relaxed zigzag tunnel, a tube, a parallel channel. In fact, it's defined by multiple weekly momentum peak closes along the top and the same angle of descent along the bottom of that momentum channel. It's a perfect parallel channel. Back in May, when silver went back over 28 bucks again on a weekly closes, 4, 5, 6 weeks ago, they have that peak right there. That momentum chart hit that channel top again and acknowledged it and backed off. But so far, the momentum hasn't dropped to channel bottom. It's dropped into the middle of the channel. Unlike prior breaks in that channel, it usually would go from channel top to bottom. So far, it hasn't done that. It's held in mid-channel, which could be a sign that it's getting ready to push the channel top again. The number changes weekly because the 40-week average changes just a little bit. But if you close a couple bucks, $2 over that zero line, meaning $2 above wherever that 40-week average is, then this momentum chart says I'm breaking out of a channel that goes back 10 months. Now, $2 over right now is about get back over 28 another time, and you're going to break out. In other words, you go back up to the May highs, you're not just back to the highs, you're breaking out on momentum. So you can reference 30 bucks if you want as a breakout. But we'd say this, if you go back over 28 again, this time it's for real. You're going to launch out of this zone. And silver's probably going to produce another stellar up move. Next page.
That's fascinating stuff there, Michael. I mean, I've got to say, as a technical analyst myself, this is absolute gold dust. And just looking at that momentum indicator, talking about sort of classical chartology or classical sort of technical analysis, that's a descending channel, which, the vast majority of occasions is a bullish chart pattern. They break to the upside, and obviously rising channels tend to break to the downside. So the odds are strongly stacked towards that breaking upwards. And everything that you've just said there in that piece is really exciting stuff for anyone that's invested in silver or thinking of investing in silver, because you're sort of drawing parallels with clearly history and what's happened with Bitcoin, and the correlations are quite striking.
Yeah, I think so. And I think that, in fact, there is an audience out there of people, the Reddit folks who look upon silver quite favorably. And I think they're right. They may be looking at it fundamentally, but technically I think it's right. Now there's, the silver and gold bulls are always a nervous crowd for some reason. I don't know why. They're always scared, even when the market's in their favor. Stock market, for example, the last dozen years of upside in the S&P, you've had 20% pullbacks and so forth. That like late 2018, the stock market dropped 20% in 6 weeks, October through December 2018. 20% drop. It took gold 9 months in a layered manner, to drop 20%, and yet it was panic the entire time. Okay, now gold's well off that low. It was 1673. We're now 1800. Anyway, here's silver price chart on a logarithmic scale. meaning, a ratio scale going back almost 50 years. And all I did with these arrows is I pointed out, look at a lot of the major highs that occurred. Basically, you spent 1 month at the high and then you dropped away from it sharply. Whereas you didn't sit up there yawning. When you got up into the thin atmosphere and broke down, you broke down. You didn't get a chance to resell it. Now look at the recent action. It's been up here for a year now, quietly pushing at the same level. It does not, even on a price chart, it doesn't look the same as any of the prior peaks in silver. So even just on a price chart basis, I suggest to silver longs and gold longs that they treat it like an investment. Quit looking at the day-to-day, week-to-week, and getting nervous about what GDX did today or what silver did today. Look at the big picture. And this is a fist. This is not a topping action. Frankly, if you do a logarithmic study of this thing and you blow through those dual highs, getting to $200 silver would be almost a swing move, okay? The ratio of the depth of this thing up to that high there. But anyway, even this price chart tells you this is not a silver top. Highly unlikely. Okay, now let's flip to gold. Because gold is the mama. And obviously silver's not going to take off on its own if gold is still laboring. Gold needs to flip back up in a convincing way. The price chart shows everything from that August peak, well actually before that, back in early 2000, but you can see the surge from 1400 up to 2070. And then in August we peaked in price. The chart below takes each weekly momentum bar and measures it against the 3/4 moving average. A 3/4 average is similar to a 40-week in duration. It's about the same number of weeks, similar to a 200-day, except it only changes once at the end of every quarter you get a new 3/4 moving average. So it sort of jolts. You can see on the top chart where there's big jumps in the 3/4 average at the end of each quarter and start of the next quarter. That's what we're measuring those weekly bars against on the momentum chart. How much above or how much below that moving average are those bars. Now, both charts developed a parallel downtrend channel since the August high, and they both broke out reasonably about the same time. So price was pretty much in synchronization with momentum. After the March low in price and momentum, there was an upturn in April, and in early May, you broke out over the parallel channel on momentum, and price even broke out above its parallel channel. Shot back up at the 1900. Now, what's interesting here on the momentum chart is the very pivotal nature of the red line that we've plotted. It goes back to the March low of 2020. Remember that little panic in gold where it dropped from 1700 down to under 1500 very briefly, a couple weeks? That low weekly close in March is the same level as was the low weekly close in November of this year, though in price, it wasn't the same level. But on momentum, it's exactly the same level, at about 2% over the 3/4 moving average. So it established a little floor there. And after the November low, you had a rally. But then when you rolled into the new year and the 3/4 average moved up again, early in January, the very first week of the year, you have that bar on the momentum that broke below the red line. On the momentum chart, there's a bar that broke below the red line. That was January of this year. And you continued on down to the March low. Now, right after you broke below that red line on momentum on a weekly basis, 2 weeks later, you went back up and bumped the line again. That's the third circle on the momentum chart. So that line is getting structured, meaning it doesn't take a great genius to start to see that line develop. And in May, when you had the rally after the breakout, where did you peak again? Again, at about the 2% level. So you now have a line that has 4 pivots on it, 2 pivotal lows and 2 pivotal highs. Well, in order to close over that line any week during this new quarter, all we need to see on gold is, by the way, the label on that bottom is incorrect. This is a gold. So I'm sorry, I mislabeled it.
That's all right.
That's a gold against weekly against the 3/4. But if gold gets up to about 18, I think the number's 1854, you'll touch 2% over again. That's about 2.5% above the highs we just made last week and this week. So another 2.5% up in gold, it's going to bump that line again. It's our view, if you even touch that line again, it's a lock sense you're going to go through it. Now, you may have to fight for it again a little bit. There may be some sellers up there who want to sell there. But notice on the price chart, most sellers will think the resistance at 1900. Why? Because you look back in January and November of last year, the rally high got up over the weekly close was up around 1900. And then the May high was up around just barely over 1900. But momentum says, no, that's not where your resistance is. If you can get a weekly close at 1865 area anytime during this quarter, I'm going to close above that red line on momentum. Not on price. Price won't be breaking out over its 1900 level, but momentum will be blowing a line that goes all the way back a year and a half. That's a major pivotal structure. So we would say on gold, you don't have to go back to that May high at 1900 plus. You just have to go to 1850, 1860. And this bottom chart is going to declare total victory in terms of an upturn. Already it's broken out of its channel, so that's positive. But the next structure is that red line. And so at that point, gold crosses that line, I would shift my vision, my goggles over to silver and start putting on position there if you're not already positioned in silver, or adding to a position in silver. Because if gold gives the green light, silver's going to launch. And I would bet if gold gets above that red line, silver's going to be pressing its level up there at 28 plus. We noted on its 40-week chart.
Kevin,
go ahead.
Kevin, don't you have shivers listening to Michael?
It is sending a shiver down my spine whilst it's been speaking. I've just been looking at my ARC constructions, and that 1850, 1860 level is very, very critical on the golden arc chart that I've got. So it's confirmatory evidence, which as a scientist is great for me to hear, because multiple evidence,
it's best to have two or three things that say the same thing at the same time. Yeah,
increases your confidence level. Yeah. But sorry, you can carry on, Michael. It's fascinating stuff.
That's very important, and we run different time scales of gold and silver as well than the ones we're showing you here, that also agree with that. So we have a little chorus of momentum charts saying, yep, you don't have to get back to 1900. In fact, you get back to that 1865 level. I said if you close a week there, you're above that red line. What price is that? Think about it a second. It's when the minutes came out of the Fed meeting, when the headline chasers started selling gold because the Fed said, oh my God, we're going to have to taper. Or maybe we will. That's actually what they said. Well, I'll give you a reason why the Fed's probably not going to taper. Next chart. This is the chart that will determine that. This is Nasdaq 100, arguably the leader index in the world, and certainly the leader in the US in terms of its percentage gain since 2009 low, and especially over the last couple of years. Now, since February this year, its rate of increase has slowed relative to the S&P. So Nasdaq actually at 100 on a spread basis, which we don't show here, versus S&P is turned down. In other words, it's lacked upside performance comparable to even the Dow Industrials. So what's going on is the leader index here with Microsoft, Apple, Amazon, and Google. Those stocks comprise about 50% of this index. About 5 or 6 stocks, or 50% of this index. In fact, those same 5 stocks, Google, Facebook, Amazon, Apple, and Microsoft, comprise about 20% of the S&P. So that's what we're talking about here. There's your leadership, and it's expressed best in this index. Okay, what have we got here? We have the monthly price chart on top, and we have effectively a 3-year average plotted below, a 36-month average. Changes every month. Now, the rise in Nasdaq 100 on price was like that Bitcoin chart before it blew off. It was layered. It was orderly. You can see. But there's a circle spot on that price chart. Last summer, when you crossed into the about 9,500 price level, you accelerated. In other words, rather than going up at a reasonable angle of ascent, like that black line on the top chart is reasonable angle. You're not crazy, okay? You went crazy. You had a blow off. And this is even more important because you've had a lot of maturity in the trend as too. It's not just, a year into a move, it went crazy. This is 10 years into a bull market, and then it went crazy. That's how bull markets often end. They end with craziness, blow off action, acceleration that just goes off the page. Now look at the momentum chart. If you go back to the overdone, what everybody would consider the excessive low that occurred at the bear market lows in 2009, where was momentum? It was 40% below the 3-year average, 36-month average. It's pretty deep. But look at all the highs that occurred at the top of that red box. 41 to 42% over at each and every high. Not 40% over, but 41 to 42, each one of them. Now, what you're saying is every time you got up to that same excessive level of 40% plus over the zero line, you would have a pullback because Nasdaq said, hey, I'm overbought. Okay. And sure enough, you'd have some kind of reasonable pullback. Some of them were sharp, in fact, on price. 1, 2, 3, 4, 5, 6 hits along that line. And then last July, when price went through its acceleration line, momentum went through the top of that box. This is like that first Bitcoin chart I showed you prior to its top at 20,000 back in 2017. It had a similar 3-point box where it bumped, bumped, and bumped, and then went through the top of the box. And Bitcoin failed back then, late 2017, early 2018, when it fell back through the box, if you recall. But that box was only, 9 months wide and only had 3 hits at the top of the box. This is a decade-wide box when it broke through in summer last year. And it's defined by 6 points. Now look what happened in October last year. A couple months after you broke out, you fell back to the top of the box. And there was a low close in October that was what? 41.4% over the zero line. So it closed precisely between that 41 to 42% level, which is where all those peaks are. And what did it do? It turned back up again. And then early this year, I think it was February, you dropped back down and touched about 42% over intra-month and shot back up again. Okay? So you've used that top of that box now and demonstrated from the top side that that's a key level. Okay, so going forward, we have a down arrow and a red circle showing the penetration back in that box. Any month that you trade back down to 42% over, I wouldn't bet on it holding this time. And any month that closes 40% over is an abort. Now, there's a red circle on the price chart. That's where the breakage would occur this month, in the lower part of the 13,000s. There was about 13,300. That rises every month by about 200 points because that's how much that 36-month average is rising. So every month you can take that little red circle on the price chart and move it up about 200 points a month. All I'm saying to the bulls is you can buy all you want. Your risk control is that close to you. It's back down in the range where we were 2 months ago. And you get into next month and that little red circle is going to move up closer to 14,000, like the upper 13,000s. I'm saying that if the Nasdaq 100, the leader index, aborts back below the top of this box, you can bet that its next trip is probably to visit the bottom of the box. What's the bottom of the box? 3 to 4 times you use the 36-month average itself, the zero line, as bear market support. You penetrated it briefly in March last year, but you didn't close below it or anything of the sort. That's probably where your next support is going to be, but that's about 40% below where the level at which you penetrate the top of the box. Now, I'm not saying you're going to go there quickly, but that's where you're headed on the next sell-off. So you got a pretty decent sell-off just to get down to next support. Kind of sell-off that even if you got 10 or 20% off the high in the Nasdaq, the question then is for all these people who believe that the Fed is ultimately going to taper because inflation, they're not going to taper if the stock market starts to break down. That's one asset category they've not had to worry about for the last year, since, let's say, last summer especially, when we went vertical. It's been a market that's accommodative to the Fed. It's not been scaring anybody. It's not been discouraging people spending. But if this market ever tops, get back in that box on NASDAQ on an annual momentum, that's going to cause decline that's going to get noticeable. And at that point, Powell and his friends are going to get very antsy because this is an indicator they don't want to talk about much. But Bernanke wrote a paper back in 2003 in which he said one of the implicit underlying factors that the Fed always must pay attention to is the stock market. They need to defend it. You don't have to tell everybody you're defending it, even though he did in that academic paper, and he even gave his speech on it. Because he said this creates the consumer sentiment that we need to maintain, sentiment that will cause spending, not savings, and it will keep the stock market up and keep various other indicators positive, like unemployment. You start to break the stock market, and potential hiring may taper off. There's going to be tapering there, in which case the Fed ain't going to taper. So this is the one market I would say that if you're concerned that the Fed is going to taper and therefore gold might go down, if this market starts to break down, it's going to cause the opposite kind of discussion to occur. And that is, forget about Fed tapering. So
Wow.
this is the market to watch now, even if you're not in it. And that's the abort of this momentum chart.
It's
So
Go
just
ahead.
this question there. I know me and Patrick sort of going to be jumping to ask a question here. The first one that comes to my mind, there's a bit of an echo there, so apologise for that. Patrick, do you want to just talk whilst I sort out the echo at this end? In fact, no, it seems to have stopped.
I hear you. Go ahead.
So the question that's come to my mind is, how does this end? So, we've got a very good case there that the Fed is boxed in and tapering is pretty much off the table, really, because if they do, the effects on the Nasdaq and the wider stock market could be catastrophic. So what this kind of plays into what I've been looking at with my sort of treasury yield charts and the sort of the discussions around interest rates in the United States and treasury yields, and the fact that the treasury yields are trying to break out, but if they get to a sort of critical 2 to 2.5% level, the mathematics, sort of back of an envelope mathematics that I've done, suggests that the Fed will be unable to sort of meet its sort of payment obligations. So that this is another chart that's kind of it's a bit of a conundrum, a bit of a catch-22, because if you never taper, then you're creating an ever increasing problem for the future. Which what's the solution to this?
Well, you would think now, a lot of people would think, well, if the Fed has her back and never going to not have her back, then this thing can't go down. That's not true. Go back and look at the 2000 top. Go back and look at the 1972, 73 top. Go back and look at the 2007 top. The Fed fought that decline 2007 to 2009 all the way down. Did they stop it? No. Okay. In other words, once a market makes a major turn, you can take the Fed and put them off to the side. Yes, the Fed sponsored this bull market. For the last dozen years, it's provided accommodative monetary policy. And investment asset managers and investors thought the best place to put it, and this was certainly true at the 2009 low. In fact, we were quite bullish then. 1 week off the low, we declared a major low. That was an oversold market. The stock market was. It was an asset category that had the total risk taken out of it almost. So it was like no risk, all reward. And the Fed was accommodative, and therefore it went up. But there's a point at which reality comes into play. And this thing's gone beyond reality. It's gone into a blow off. And so even if the Fed doesn't taper and continues its policy, even more aggressive, let's say, it won't help this market. Asset managers will take that river flow and they'll push the river flow in a different direction. They've done it before and they'll do it again. They did it in the late 70s. The Fed was accommodative. The stock market went sideways. It was a wasteland until 1982. Commodities were the place to be. Gold. I think a similar outcome is setting up now, where the Fed can't change its policy, because if this goes down, the unemployment picture is not going to meet their levels, which is something Powell mentioned that nobody talked about too much after those minutes. As he said, we want to see unemployment get to levels that it hasn't gotten to and stay there. Well, if this market starts down, that's going to be a big question. Anyway, so I think what will happen is if this shifts to a negative mode and goes into a bear trend, like a normal bear market, meaning layered, not a collapse, that further asset shift will occur, meaning more money will flow into gold that began in March. More money will flow into T-bonds over the next several months that began at the low in March, when the asset class shift began at that point, and will accelerate. There's a point at which, however, I think the T-bonds will get suspicious, where the drop in yields could change. And we end up with only one asset category that's preferable. No longer long-term government debt, but basically gold and silver. And to some extent commodities, which have a long way to go on the upside in our view. You're going to get your correction in commodities. You're getting it now by default because of rotation out of front months that are more highly priced than the next month. You look at corn, for example, or soybeans. The July contract's about to go off, and if you look where the next contract is, it's already priced well below the July. So it's going to cause some downticks in the Bloomberg Commodity Index, that simple rotation. That's a corrective process. It's not a bear trend in our view. So Powell's in fact going to get what he said to expect, and that is that inflation looks temporary. Because a lot of these come out, look at lumber, for example, the market he cited, it collapsed. In fact, we put out a report when lumber was at 1,700, said this is probably the top, it's now at 700. Lumber was somewhat unique. It is, in fact, over fully, but most commodities aren't. But they're going to get pullbacks that will make him look right. So the pressure on him from a lot of economists to this is not temporary. He's in fact going to get some evidence out of some markets that says, he was right. Look, soybeans backed off, et cetera, et cetera. Enough of them did, so the Bloomberg cooled off a little bit. But that's going to be temporary. So I think really the biggest winner of the abort of this Nasdaq is going to be gold and silver, because it means the central banks are going to have to defend their stock markets again, something they haven't had to do for a year.
Can I just ask you, I know Patrick probably wants to ask you a question, but something just that I'd like to hear your response to. The gold market is cyclical, and I'm sure you're aware of the 8-year cycle and 16-year cycles in low 2000, 2008, 2016. The next sort of 8-year cycle low in gold should be sort of coming in sometime late 23 to perhaps late 2024, that kind of time period. I know the US election is in November 2024. Just wondered if you have any view at all on whether precious metals in particular are likely to suffer a particularly large pullback into that 8-year cycle low, or whether it's...
Yeah, but I think it could be historic. I think it's going to be a chaos theory high. Those were incremental bull markets that did accelerate later in their trends. You're right. And they do have a cyclicality, but we only have like 3 of them. So it's hard to, gold really didn't start till 75, the futures market. Before that, it was pretty much controlled market at $35 an ounce type of thing. Yeah. So I don't know if we got enough history there. But I think that because of the events that are happening, I'm speaking macro technicals now, but also there's a fundamental thing going on here. But when this beast here, you're looking at Nasdaq 100, when it starts to break through the top of that box, and especially when he goes through the bottom of that box, and finally breaks his 36-month average, which might be something a year from now, let's say, after, zigzags. But when that happens, a crisis of major proportions is going to occur that will be monetarily driven, because if the Fed can't take its foot off the pedal, because so many things depend on it keeping its foot on the pedal, like the ability to pay for government programs, okay, to ensure government pension funds that can't meet their obligations, because why? The stock market goes down and they're not getting yield from bonds. So they've got to have the stock market continue up, or the pension funds have problems. So suddenly they have to fund that as well. You're going to have a fundamental political, social, economic crisis like we haven't seen before. And my suspicion is that because of the nature of the long-term technicals, like that we're looking at right here, or that silver chart, that logarithmic silver chart I showed you, the price chart, that the next bull trend we get in the precious metals, the monetary metals, excuse me, not the precious. I don't include platinum in this. And the downside in developed economy stocks, and what happens to government bond markets, which I don't think is going to be nice. I don't think it's going to be a continued drop in yields, rise in price like we're going to get right now. I think that after this next rise, you could go the opposite way. That instead of an incremental bull move in gold, it's the normal clock. That between now and let's say late next year, not 23, not 24, but 22, you could get gold up to $8,000, $10,000 an ounce. And I think if you do that, you're going to have silver at $200 plus an ounce. And it's not just based on looking at silver's logarithmic scale, but it's also based on some spread relationships of silver to gold that go back 50 years.
When you say spread, essentially it's like the gold to silver ratio, right?
Somewhat? Correct. Yes, correct. Except on a percentage basis. And silver, if it just got back to sort of a normal sub-level high, and I'm not talking about the 1980 high when gold was $200 and silver was 50. Okay, that ratio was enormous. I mean, silver was 25% the price of gold, right? But if silver went just back to like a 3% price value of gold, which a lot of its peaks since that 1980 peak have gone back up there routinely. It's like a sort of a normal level. Well, you get $8,000, $9,000, $10,000 gold. You're talking silver well in the hundreds. So I think silver could become the next Bitcoin based on my view of its technicals and my view of its ratio to gold and how that looks historically. And also what's going on in the other major asset categories, such that you're left with basically one area to be in if you want to do what Ray Dalio said, and that is be concerned about the value of your money.
Man, it's insane hearing you, Michael, because a lot of the it's is the echo going to disappear? Testing. Hello?
We're here.
It's so weird because when I start talking, there's like an echo, and then after it disappears.
I can't hear it.
It's like all your work, man, because it's like complete. It's like a weight of evidence. It's not just one chart. You seem to look at the ratios, the spreads, the markets, the impacts, and you even dive into the fundamentals. It's like I didn't know, like it's really complete there, the view, and I can't believe we got to cover a good chunk of it today there. And I know we've seen like fractals happen over and over, like the Ethereum chart. They look like silver on steroids. Bitcoin kind of looks some types of fractals like gold did on steroids, and silver and gold had a tendency to seem to play out on a longer time frame, but structurally, that word, man, I'm probably gonna steal that word from you. They're built the same.
Yeah, no, I think we've got a situation where what we saw in Bitcoin over the last year, summer of last year, it was 10,000, went to 65, okay, with less than a year, 9 months. We could get something similar out of gold and silver easily because it's not just what they're doing. It's not just the normal behavior, because I think we're going to have abnormal behavior. Even the technicals sort of bear that out. But it's what's going on with these other markets that were favorable places to put your money. If they become disfavorable, then what are you going to do? It's got to go somewhere. And frankly, buying bonds is, that's like, it's cash, but you're not making any yield. So that's really not a real alternative in terms of, and especially if it becomes a risk at some point, which we think it could become. You're left with pretty much commodities and gold. And by the way, our assessment of gold and silver is such that commodities is going to be nice, I think, the next couple of years on a percentage basis, and commodity-related stocks, especially oil stocks, mining stocks, agricultural-related stocks, fertilizer. They're not going to match gold and silver on a percentage basis. Just like they did not match gold and silver on a percentage basis in the late 1970s to the 1980 peak. Gold beat them.
So a final question for you, Michael.
Yes.
Just as far as timescales are concerned, when roughly sort of timescale do you see the commodities and precious metals reaching the sort of tops of the coming sort of bull market? Is it a little bit early to say that yet, or do you have a sort of rough time frame in mind?
I think what we've just seen is the first breakout thrust on commodities. We measured Bloomberg, and most commodities broke out by our metrics, annual momentum and quarterly momentum, in November of last year. You go back and circle where November was on most commodities. Oil was $40, soybeans were $9.30 at our breakout point, corn was, et cetera, et cetera. They had a huge percent surge with no particular reason. In other words, it wasn't a crop drought that caused soybeans to go up, corn and wheat. It was something else going on, okay? And sugar, and too many things were in coincidence. That was a breakout thrust. And it was like they were beach balls pushed below the water level for 5 and 6 years. Prices of commodities were at very low historic levels and kept there since 2016. So when they came up and broke out on long-term momentum, they whooshed. Now they're having to pull back from the whoosh, but it's a pullback to buy. Now the question is where, and each market needs to be analyzed separately. But I strongly suspect it'll be enough to where Powell will be able to say, see, I told you it's just temporary. That'll be a false conclusion, but he'll be able to say it. This pullback in commodities will be a buying opportunity for commodities and commodity-related stocks. So I view it that way. Wow. But they are going to get a congestion zone and a pullback. It makes sense. They had too much too quick after the breakout. I would think the trend would be similar to gold and silver, meaning you would see your best levels by later next year, which is to say a fairly short cycle compared to what you described in the gold cycle, for example. Anyway, that's my thoughts.
Wow. Michael,
all I can say is that I think we're absolutely the information that you've given us there is absolute gold dust. And, I hope everybody that's watching this appreciates it as much as me and Patrick do.
Yeah, definitely. It was an honor, Michael.
Our website is www.olivermsa.com for momentum structural analysis.
And I'll put
our
all,
methodology there and so forth.
yeah, I'll put the links in the YouTube. I really hope my recording went well, or else I'll just be an excuse to do this again, Michael.
Thank you, Kevin. Thank you much.
We thank you for your time. I learned a lot today. It's insane.
Yeah, it was an honor. Thank you, Michael.
Thank you.